You ever wonder what option is the best? Should you use conventional financing or FHA financing? You read through stuff on the internet, but you don't truly know. You get bits here, pieces over here. Well, today I'm going to walk you through 5 different criterion so that you can walk away understanding what I look at when I help clients decide if an FHA loan or a conventional loan is the best fit for them. My name is Aaron Benton. I'm host of this channel and a local mortgage lender, and I'm looking forward to talking to you about the 5 different comparisons that I look at when determining whether to use a conventional loan or an FHA loan. The first piece that I look at is uninsured versus insured. So in terms of safety for the bank, an FHA loan is insured. And what that means is that the loan is guaranteed, it's federally backed. A conventional loan is not. There's more risk on the lender. Technically, these conventional loans, through the eyes of the lender, are a little bit riskier because they don't have the government to come in and support them and bail them out should you default on the loan. So an FHA loan is going to naturally have slightly lower interest rates. Interest rates are a product of risk. So understand that the FHA loan will have a slightly lower interest rate because it's a safer loan for the bank than that of a conventional loan. So first being insured FHA loan, uninsured conventional loan, that is one of the reasons why you see a difference in interest rate. Historically, FHA loans having lower rates than conventional loans. They're also more forgiving when it comes to credit scores. So FHA will go all the way down 3.5% financing. And you can use 3.5% as a first-time home buyer, you can use 3.5% as a move-up buyer or any kind of future purchase. As a conventional loan, many times you see 5% down. Now, if you are a first-time home buyer utilizing a conventional loan, you could put down as little as 3%. But understand, that's for a first-time home buyer. What constitutes a first-time home buyer? You cannot have owned a home within the last 3 years. So could you be a first-time home buyer more than once per the guidelines? Of course. But many times, once you buy your first home, you're going to continue owning and moving up. So after you get to use that 3% down on your first purchase, then you're going to be grandfathered into a 5% down as the minimum. The next comparison is credit score. So FHA will actually go down to a minimum credit score of 500 per the guidelines. Fannie Mae and Freddie Mac conventional loans, they just waived their minimum credit score requirements. It used to be 620 for primary purchase. It used to be 680 for an investment. They've waived those. But you still need an automated system approval. Nevertheless, FHA loan would allow you to go down to 500. Conventional loan, it's up in the air. Now, with an FHA loan, just because you're able to go down to a minimum score of 500, you still need to get what's called an automated system approval. So you're going to look at what's called, or the bank's going to look at what's called a total scorecard, where it's going to look at your income, your debt, your credit score, your down payment, kind of your whole history here. And it's going to render whether or not you get an approval, and basically that is a good loan for the bank to write. Same thing on the conventional side. Now understand, you don't have to have a credit score in 620 anymore. You don't need to have that minimum score. But again, you run this what's called automated system. It's called an AUS, automated underwriting system. And looking at your file in whole, down payment, credit score, income, your payment history on credit cards, car loans, things of that nature, you will render it, the AUS will render a decision. The automated system will render a decision. So yes, credit score is more favorable and forgiving on the FHA side, and whereas conventional, it's up in the air. But recognize when you have a low credit score, that is when you start to see FHA really honing into what is best for you. Because FHA is more forgiving when it comes to interest rate and mortgage insurance on a FHA loan. So as your score starts to go down, there are think of it as a ticket. Like if a speeding ticket, the faster you go, the faster you went above the speed limit, the more marks on your license. Well, with a conventional loan, the lower that score gets, the more dings you get on what the interest rate offering would be. So you start to go down in score, say you're dipping below 700, and an FHA loan is most likely not only going to have a better interest rate, but the mortgage insurance will be better. I'll talk about mortgage insurance a little bit later. So conventional financing, you start to see deterioration in score. Your interest rate offering could be impacted more dramatically than that of an FHA loan. So credit score certainly plays a role in your interest rate. Now, the down payment, that's another comparison piece. Conventional financing will allow you to put down a minimum of 3% down for a first-time home buyer, but should you put down, or should you be a repeat buyer, you gotta put down 5%. So what constitutes a first-time home buyer in conventional eyes? You can't have owned a home in the last 3 years. So could you, in theory, qualify to get a first-time home buyer and put down 3% more than one time in your life? Absolutely. But is that happen all the time? No, that's kind of a rarity, because once you buy, you start to move up the ladder. Understand that an FHA loan, the minimum down payment is 3.5%. And that 3.5% down, it can hold like that. You can put 3.5% down on your first purchase. You could do 3.5% down on your next purchase. There is no limit to that. You can constantly put down 3.5%. FHA or conventional, as you can tell, there's a scale. The next part, though, to understand is FHA loan is only for primary home purchases. Conventional financing, you want to buy a second home or an investment property, conventional options, that's your ticket, it's your only ticket. A minimum down payment for a second home is 10%. A minimum down payment for an investment property is 15%. So understand down payment does play a role, and it plays a role in how people actually decide what program is for them. So so far we've gone over insured versus uninsured. We've noticed that FHA has lower credit scores holistically, simply because they are considered less risky because the government backs them, so naturally lower interest rates. FHA has a 3.5% down minimum down payment. Conventional most times 5% unless you're a first-time home buyer. FHA minimum credit score is 500. The lender might have overlays, meaning that you can't always go down to 500. Like for my company, should your credit score dip below 580 on an FHA loan, I need you to put down 10%. You can't just simply put down the 3.5%. Another option, loan limits, or another comparison piece, loan limits. You'd be amazed how many people call me and they say, hey, I want to get an FHA loan. And I say, well, what are you buying? And they say, I'm buying $1 million place. And I said, the maximum loan amount for an FHA loan in Beaufort County, Jasper County, South Carolina is $638,250. $638,250. That is the loan limit for an FHA loan in Beaufort and Jasper County in 2026. Conventional financing, Fannie Mae, Freddie Mac, $832,750. So as you can see, the loan limit is different. So as we start to stem up in value or purchase price, conventional loan starts to become a little bit more prevalent, simply because the loan limit, as you can see, is almost $200,000 more. So when you get an FHA loan, you actually pay this upfront mortgage insurance. You've probably heard of it, it's called UMIP. And it is 1.75% of the loan amount. Now, it is a closing cost that gets financed into the loan, but it's something to take into consideration, because if you're getting a loan for $300,000 and you start to see on there that you're gonna be paying north of $4,000 that gets financed into the loan, it's just something to take into consideration. Again, you still have to put down the 3.5% as the minimum, but if you're have a fee of 1.75%, your equity stake in the property when you leave is actually, or when you close, is actually 1.75%. So upfront MIP is only in existence on a FHA loan. A conventional loan, there is no upfront mortgage insurance. So if you are thinking that this is a very, very short-term place for you, maybe a year, you need to take that into consideration, because an FHA loan, you're going to get hit with that 1.75%. Conventional loan, not so much. Now the next part is, with conventional financing, if you put less than 20% down, you have mortgage insurance. On an FHA loan, you have mortgage insurance forever. Even if you hit 20% equity in the home, you could get an FHA loan, put down 20, 30, 40%. You're still paying. Yes, you're still paying the upfront mortgage insurance, and you're also paying mortgage insurance on a monthly basis. An FHA loan, it sticks with you like a glove. Conventional financing, once you get 20% equity in the home, you call your loan servicer, you get rid of that mortgage insurance. That fee will drop off of your loan. So just a little tip, a lot of people don't know this. Once you get 20% equity in the home, you need to call your loan servicer, tell them that you have 20% equity in the home, and the mortgage insurance will go away. If you don't call, it actually drops off when you have 22% equity in the home. A lot of people don't know that. They don't realize that they have to call their loan servicer when they get 20% equity in the home to actually be relieved of mortgage insurance. So that's a really good tip for you today. Make sure you're paying attention to the value of your home versus the mortgage. During COVID, we saw values appreciate dramatically, so people were able to get out of mortgage insurance relatively quickly because of the rapid appreciation. So mortgage insurance is something to certainly take into consideration. So what ultimately constitutes when to go conventional financing or when to go FHA? Well, when you look at like the total scorecard, if you will, or look at the file in whole, think of interest rate as a product of risk. If somebody has a lower credit score, you start to think, okay, maybe an FHA loan. FHA is a little bit more forgiving when it comes to credit score. Conventional financing, you start to get hit a little bit. Mortgage insurance is risk-based. So with a lower, it doesn't matter with FHA if you have an 800 credit score or a 600 credit score. Your mortgage insurance is a formula, and it is simply, that is the mortgage insurance based on a formula. If you put down anywhere from 3.5% to 4.99%, it's 0.55 of the base loan amount divided by 12. And if you're putting down 5% or more, it's 0.5% of the loan amount divided by 12. And that's the monthly mortgage insurance. As you can tell, I just rattled off the formula for FHA. If you are getting a conventional loan, it is risk-based. So what goes into mortgage insurance? Credit score, down payment, debt to income, believe it or not. Monthly debt to income plays a role in your ability to get mortgage insurance, or I should say the most inexpensive or the most aggressive mortgage insurance. So basically what I tell people is we have to compare. If you are on the fence, if you are hovering in a 620 or 720 and below credit score, 720, 690, that is really where you're going to notice that the comparison between FHA and conventional financing really becomes valuable to you. And I love sharing those numbers. If you liked hearing that, so make sure you subscribe below, because that is certainly something to take into consideration. That 720 to 690 range is where you really start to look at the comparison of what one is better. You get a credit score that is greater than 720. I will tell you that the conventional financing is most likely a little bit better. And of course, if you dip below the 690 mark, you're probably going to be looking at an FHA loan. But just because I say that, one size doesn't fit all, and we certainly can look at any option that you want. My name's Aaron Benton. I'm host of this channel and a local mortgage lender. I would love to understand your scenario. Again, subscribe below, like the video, tell your friends about it. I do think that whether you're a first-time home buyer or a move-up buyer, or maybe you're trying to buy a second home, all information very valuable here that I look forward to assisting you with. So book that call with me, because I'd love to get to understand your personal situation. But if not, I'd at least like to see you on the next video. Thanks for listening in.